due to factors like 3 years of COVID-19 restrictions, real estate prices, and a crackdown on private enterprises, as well as decreasing demand in exports.
460,000 companies closed down, 800 million people in debt. China's 2023 economy has no way out. In a world of rapidly changing economic landscapes, China faces an unprecedented challenge in 2023. The collapse of 460,000 businesses has resulted in the loss of work for countless people, and the burden of debt has become unbearable for an astounding 800 million people worldwide. In today's eye-opening video, we'll delve deep into the intricate web of causes behind this economic calamity, examine the impact on China's population, and explore the reverberations felt across the globe. Is there a viable solution on the horizon for the world's second largest economy, or are we witnessing the start of a catastrophic decline that could reshape the global financial order? Come with us as we explore the reasons for China's economic collapse in 2023 and its far-reaching effects. China has benefited from catch-up growth since reform and opening began in 1978. The country was starting from such a low point, and its large market had so much possibility that its officials didn't have to do much other than stay out of the way for significant growth to occur. Even significant cyclical slowdowns were usually followed by a return to fast expansion. Will the repeal of China's zero-COVID policies have the same effect in 2023? Some experts believe so, forecasting a strong comeback in the world's second-largest financial benefits, fueled by pent-up consumer demand. Foreign governments and multinational enterprises must decide whether to believe the optimists or the pessimists. The government provided data, and our analysis of the performance in the fourth quarter show that full-year GDP growth in 2022 will be approximately 2.5%. Nevertheless, there are various reasons to assume that the actual performance was considerably lower. Despite a worsening downturn in the property industry and lockdowns in multiple cities, Beijing statisticians report an acceleration in growth in the first quarter of the year compared to the previous quarter. The real estate market continued to experience stagnation during the course of the year, with finished floor space falling by almost 20% in the first 11 months of 2022 compared to the same time period the previous year, and new starts falling by nearly 40%. However, Beijing continues to report growth in fixed asset investment of above 5%, which is nearly the same level of growth as in 2018, which was well before the slowdown in the property industry began to take effect. Because China is so focused on producing solid outcomes, we anticipate that the country's official growth rate in 2022 could reach as high as 3%. In point of fact, it's quite likely that economic growth was lower than 2%, and there is even a chance that it did not expand at all. We can now look further to 2023, now that we have a baseline for 2022 to work from. Even though the weight of the zero-COVID restriction that has been hanging around the Chinese economy's neck will be lifted by the end of the year, the abrupt and disorganized manner in which the pandemic guidelines have been altered means the expansion will be impeded in new and different ways. It is critically important to note that the economic challenges that are unconnected to COVID are likely to continue or even get worse. We'll examine each one in turn. Housing continues to be too high for underlying actual demand after the 2022 slump. We estimate an appropriate level of demand, one associated with buying houses for living rather than speculation, to be between 550 and 750 million square meters per year. After peaking at 1.73 billion square meters in June 2021, China's yearly residential sales are still at 1.24 billion square meters. Construction must continue to contract at the present pace for 4 to 6 more quarters in order to reach sustainable levels. Infrastructure investment is also likely to be a drag. Local governments are under financial strain as a result of falling revenue from land sales. Local government financing vehicles, or LGFVs, which are the major means for completing infrastructure projects, are experiencing a credit crunch and are expected to default in 2023. Policies have been designed to reduce the amount of low-return investment projects, while rules were slightly relaxed in April 2022. Policy bank financing has been utilized to fill the most severe deficits, but these spigots cannot compete with last year's 1.4 trillion yuan in quasi-fiscal loans. Together, these limits suggest that infrastructure will be a minor drag on GDP in 2023 rather than a source of growth. Finally, given the current COVID-19 disarray and continuous doubt regarding the state's attitude toward market forces, it is difficult to envision private sector investment in new production lines or retail spaces, for example, driving growth. Private companies frequently take their cues from global customers rather than Beijing. According to the IMF, global trade growth will decrease from 5.5% in 2022 to 3.8% maximum in 23, or as low as 1.2% in the worst of a worldwide recession. In these circumstances, China's export-oriented firms will be hesitant to invest in new capital stock and infrastructure. During the pandemic, exports were a significant development engine for China. In pre-pandemic years, net exports contributed between -1 and +1 percentage points to the GDP, while in 2021, net exports contributed 1.7 percentage points to growth, driving the country to 8.1% growth. Given China's huge trade surplus, net exports are likely to account for 1/3 of 2022 growth. However, we might anticipate reduced external demand in 2023. In addition to deteriorating global conditions, domestic policy uncertainty is likely to impede export performance. To keep personnel safe from the virus, manufacturers created closed-loop systems. Employees with COVID are now being told to come to work in order to get past lockdowns. Production's likely to be delayed for much of 2023 in a chaotic environment characterized by high infections and worker absenteeism. Despite these conditions, an already historic surplus would have to widen further for net exports to contribute to 2023 growth. This is theoretically feasible, but we believe it is unlikely. If China's trade terms altered significantly in its favor, with import prices for oil and other commodities falling and export prices remaining stable, an additional 0.5 percentage point GDP contribution from net exports might be achievable. However, it is more likely that China's export growth would continue to decelerate, with the net exports acting as a 0.5 percentage point drag on growth. Total consumer demand is divided into two subcomponents in GDP accounting: household and government spending. Household expenditure is the largest unknown for total growth in 2023. Households were severely constricted in 2022 as a result of lockdowns and travel restrictions, and prospects for a consumption rebound in 2023 are dependent on a burst of pent-up demand triggered in response to the zero-COVID exit. However, there are various reasons to be wary about an increase in customer demand in 2023. Households are saving at record levels, particularly in savings accounts with maturities of 3 to 5 years, which are costly to redeem in the short term. Unemployment among employees aged 16 to 24 approached 20% earlier this year and remains high at 17%. The global recession will almost certainly have an impact on employment in China's export-oriented manufacturing sector. The slowing of China's property industry will continue to harm job prospects in construction and associated industries, impacting employment and income. The government is attempting to stabilize property values expectations, but home values in the secondary market, which is less regulated, are already declining in Tier 2 and Tier 3 cities. Falling property values often dampen consumption since real estate accounts for a sizable portion of household wealth. China's very restrictive COVID rules contributed significantly to the country's poor economic performance in 2022, and the removal of these policies should bring a boost once disruptions caused by the virus's uncontrolled spread subside. However, zero COVID was only one of several growth stumbling blocks, and the others are not going away with a waving of Beijing's policy wand. Demographics are a constant and long-term drag. The National Bureau of Statistics estimated a population increase of only 480,000 individuals in 2021, indicating that China has reached its demographic peak. For some years, the working-age population has been dropping, with fewer young people joining the labor force and more people retiring. Furthermore, there are grave concerns regarding the educational preparation of tens of millions of young rural Chinese entering the 21st century economy. China's financial system has hit its limitations after a decade of credit-fueled development. Banks have been saddled with undetected non-performing loans for a decade, which must be rolled over year after year. Banks have had to use a growing amount of new credit to maintain the engine running at the same speed as the pool has grown. Productivity growth should be a driver of economic expansion in China as it enters the middle income stage. However, the productivity wellsprings are not running as freely as they once did. In some places, the economic reform program has been halted or reversed. Beijing continues to pursue costly industrial policy schemes that have produced nothing in terms of productivity or self-reliance. The private sector and international enterprises are becoming increasingly suspicious of regulatory and ideological signals. Finally, China faces serious climate change challenges. While the green transition will affect both developed and developing economies, China bears a disproportionate share of the cost due to its reliance on heavy, carbon-intensive sectors. As we've covered today, China's 2023 economic crisis has far-reaching consequences, impacting not just the lives of millions of Chinese citizens, but the global economy as well. If you found this analysis insightful and want to stay updated on the latest developments in this unfolding catastrophe, be sure to subscribe to our channel.